Welcome to the Deep Dive, where we take a stack of information and distill it into those essential nuggets of knowledge you need to be truly well informed. Today, we're plunging into the heart of the market, what's driving the headlines, the surprising shifts, and what it all means for where your money might be moving.
Yeah, we've pulled together quite a bit for this deep dive. We've got detailed market reports, company earnings calls, commodity forecasts, the works. Our mission really is to cut through all that noise, zero in on the crucial economic data, look at the latest corporate report cards, and, spot those surprising signals shaping today's trading. We'll definitely be highlighting potential gainers and losers along the way.
Okay, let's unpack this then. It's August 14th, 2025, and the U.S. stock market seems to be standing at, well, a really crucial point. We just had that powerful two-day rally pushing the S&P 500 and NASDAQ Composite to new record highs. But this morning, there's a definite sense of caution. What's causing this indecision, and why should you be paying close attention right now? That recent bullish run, the one driving stocks to records, it seems like it's been almost entirely fueled by these escalating expectations, hopes, really, for a Federal Reserve interest rate cut in September. Traders are pricing in, almost 100% probability of a cut. But that optimism, it feels like it's facing its biggest test today.
It absolutely is. What's fascinating here, and maybe a little nerve-wracking, is that the market's entire direction today seems to hinge overwhelmingly on just one critical data release, the July Producer Price Index, the PPI. That's due out at 8:30 a.m. Eastern. And this isn't just any old report. It's a really key leading indicator for the Consumer Price Index, the CPI. It gives us a peek into the pipeline of price pressures, before they actually hit consumer wallets.
Right, so PPI is what producers are paying, CPI is what we pay.
Exactly. PPI tracks the average change in prices domestic producers get for their stuff, basically, wholesale prices. So if those go up, it's a pretty safe bet consumer prices, the CPI, will follow. Now, the consensus forecasts, they suggest a modest acceleration. Both the headline PPI and the core PPI, that's the one stripping out volatile food and energy, are expected up 0.2% month over month for July, year over year. That's where you see the pickup. Headline PPI is projected at 2.5%, that's up from 2.3%, and core PPI at 2.9%, up from 2.6%.
So 0.2% month on month doesn't sound huge, but that year over year jump, that's noticeable. If the actual number comes in harder than that, what happens?
Well, that's the million-dollar question today, isn't it? A cool print, meaning in line or maybe even below forecasts, would reinforce this whole tan inflation story. That would likely push stocks higher, solidify those September rate cut bets. But a hot print, unexpectedly high, that challenges the whole narrative. It could trigger a really sharp negative reaction.
And the market's conviction about that rate cut is, as you said, exceptionally high. It feels like we've moved past if the Fed will cut to just debating how much. But given the Fed usually likes to be cautious and inflation's still kind of lurking, what could actually make them pause? What signals are they watching that might give them second thoughts, despite that almost 100% market expectation?
That's a great point, and it really underscores the tightrope we're walking. The market's confidence right now comes from, well, a couple of things. Weaker than expected job growth over the last 3 months, and generally moderate inflation data. You look at the CME FedWatch tool, a tracker of investor expectations, and yeah, it shows near certainty for a cut in September. A 25 basis point cut, 0.25%, that's the base case. But then Treasury Secretary Scott Bessent throws in that comment about a good chance of a more aggressive 50 basis point cut. And that just poured fuel on the fire, creating these sky-high expectations. But to your question, what makes the Fed hesitant? It's still inflation. An unexpectedly high PPI today would be the biggest wrench imaginable. It hits their core mandate and could force a major rethink.
Okay, and that ties right into the other big piece of data today, doesn't it? Besides inflation, the jobs market is critical. We've got the weekly initial jobless claims data out too. For months, it feels like we've heard bad news is good news. When it comes to jobs, weaker numbers mean the Fed might cut. Is that still the logic, or are we getting close to a tipping point where bad news is just bad news?
We might be right at that tipping point. It's a really important question. The consensus forecast for jobless claims for the week ending August 9th is 228,000. Now, in the current setup, a higher number, say 240,000, would probably still be seen by many traders as good news. Why? Because it suggests a cooling economy, reinforcing the case for the Fed to step in and cut rates. But, and this is the crucial nuance, that logic is getting precarious. Investors have been cheering economic weakness, thinking it forces the Fed's hand. But if the data gets too weak, if jobless claims spike dramatically or other indicators really start to flash red, then it stops being about rate cuts and starts being about a potential recession. And a recession crushes corporate earnings. That's fundamentally bad for stocks, and even Fed support can't completely paper over that. You look at the VIX, the fear gauge, it closed pretty low at 14.49. That signals low expected volatility, but it could also be complacency. A hot PPI could shatter that calm pretty quickly and force markets to confront the reality of economic weakness, like we're seeing in some earnings.
Let's shift gears slightly. Yesterday, the U.S. market looks great on the surface. S&P 500, Dow, NASDAQ, all hitting new records. But you mentioned something interesting happening beneath the surface, this sector churn. Tell us about that. It sounds paradoxical.
It is paradoxical. That's exactly the word. While the headline screamed record highs, if you look at what was leading, it actually shifted. Leadership moved away from those high-growth tech stocks and into more economically sensitive cyclical sectors. Think materials, healthcare, energy, consumer discretionary. Those sector ETFs, the SPDRs, they all had strong gains, like 1.2% to 1.9%.
Wait, so cyclicals were rallying because the market expects rate cuts, which are usually a sign the economy isn't strong. That doesn't quite add up.
Exactly. Lower interest rates typically help growth stocks because their future earnings look more valuable today. Cyclicals usually thrive when the economy is booming. So investors buying cyclicals because rate cuts are coming a signal of potential weakness, it suggests. Well, confusion maybe. It's either a really sophisticated bet on a perfect soft landing, where rate cuts neatly sidestep recession and reignite growth, or you could say the market's experiencing a bit of schizophrenia, trying to process genuinely conflicting signals, pulling it in different directions.
Feels like mixed messages, for sure. How are things looking outside the U.S.? Are international markets buying into this optimism, or are they seeing the same contradictions?
International markets seem to be offering a more, shall we say, sober assessment, maybe less conviction about that perfect soft landing. In Asia, mostly negative. Japan's Nikkei dropped quite a bit, 1.45%. The yen strengthened, partly on expectations the Bank of Japan might get more hawkish. Treasury Secretary Bessent even commented the BOJ is behind the curve, amplifying that.
In China, we keep hearing mixed things there.
Yeah, China's data was worrying. The Shanghai Composite dipped 0.46%, Hong Kong's Hang Seng down 0.37%. This came after official data showed Chinese bank lending actually contracted in July for the first time in 2 decades. That's a significant signal of economic weakness. Europe was a bit better, modestly higher, up about 0.3%, mostly riding on those U.S. rate cut hopes. But even there, you saw individual weaknesses. Like the Danish brewer Carlsberg plunged after disappointing earnings. Shows company specifics still matter hugely.
Okay, let's talk earnings then. Today's session is packed with them, giving us that ground level view, which, as you said, sometimes clashes with the broader market mood. Let's start with what sounds like a major warning shot from an industrial giant.
Yes, Deere & Company, ticker DE, the farming and construction equipment behemoth. They delivered a really cautionary report this morning. Now, they narrowly beat earnings per share estimates, $4.75, but revenue, down 9% year-over-year to $12.02 billion. But the really concerning part, the reason the stock dove over 6% in pre-market, the collapse in their production and precision agriculture unit, net sales there plummeted 16%, and operating profit in that unit collapsed by a staggering 50%.
Wow, 50% profit drop in a key division.
Exactly. And looking ahead, Deere lowered the top end of its full-year profit forecast, and they projected a dire 30% decline in sales of their big farm equipment in the U.S. and Canada for the fiscal year. This report is a major red flag. It's concrete proof that bad news on the economy is translating into real demand destruction. It directly challenges that neat, soft landing story. When a company like Deere sees demand fall off a cliff like this, it says something serious about the economy's foundations.
Okay, but then in stark contrast, we have an e-commerce powerhouse from China delivering surprisingly good news.
Right. JD.com, ticker JD. Completely different story. They delivered a stellar second quarter report, just crushed revenue expectations. Total revenue surged an impressive 22.4% year over year to almost $50 billion, way ahead of what analysts expected. This gives us a potent counter-narrative to that weak Chinese lending data we just talked about. It suggests the Chinese consumer, or at least a part of that market, still has underlying strength and resilience despite the broader economic headwinds. It really speaks to the power, maybe even the necessity, of e-commerce these days.
Fascinating contrast. Another big one to watch is Applied Materials, AMAT, reporting after the close today. Why is this one so critical, especially with all the buzz around AI?
Applied Materials is absolutely crucial. They supply the complex equipment needed to make semiconductors. So their results are a barometer for the entire artificial intelligence hardware boom. The bull case is obvious. Demand for advanced AI chips for data centers is skyrocketing. That should be great for AMAT. But there's a significant bear case, and it's all about geopolitics. U.S.-China, trade tensions, export restrictions, those pose a direct threat. We already saw their revenue from China fall 37% year-over-year last quarter. Investors will be hanging on every word of their forward guidance, especially about China. This isn't just about AMAT's stock. It's a window into the health of the global tech supply chain and how these geopolitical games impact real companies.
And sticking with the consumer, you mentioned earlier we're seeing a clear split, almost like two different economies operating side by side.
Absolutely. It's becoming quite stark. Look at Tapestry, ticker TPR. That's the parent of Coach and Kate Spade. They gave an encouraging signal about the higher-end consumer, beating estimates on both earnings and revenue. It suggests that affordable luxury segment is holding up well. People are still buying those handbags. But contrast that sharply with Carlsberg, the mass-market brewer. They missed expectations and explicitly warned about a subdued consumer environment. And we heard something similar from Cava Group, the fast casual restaurant chain. They noted their customers are dealing with a lot of headwinds and uncertainty. It paints this picture of a two-tiered consumer economy. The premium consumer, still confident. The mainstream consumer, really feeling the pinch from inflation and economic uncertainty. It's like our grocery bills and our maybe more discretionary spending habits are telling completely different economic stories.
That's really powerful and relatable insight. Any other notable movers today, potential gainers or losers catching your eye?
Sure. On the potential losers side, Coherent, ticker COHR, its stock sank about 18%. They reported a wider than expected loss and gave a mixed forecast that just didn't sit well with investors. It kind of highlights how companies that miss expectations, especially on growth, can get punished right now. On the potential gainer side, Warner Bros. Discovery, WBD, that jumped 7%. There's positive buzz around a possible strategic split of the company, plus some insider buying. That's interesting not just for WBD, but it reflects a broader theme in media companies rethinking structures to unlock value. Match Group, MTCH, up 6%. Good Q2 results and signs of a turnaround at Tinder led to analyst upgrades. Shows even mature platforms can find new growth. And AMD, Advanced Micro Devices, up 5%, riding that general chip sector momentum fueled by rate cut hopes and, of course, the ongoing AI excitement.
Okay, let's check in on commodities. They often give us that raw, unfiltered read on global demand and inflation. What's the story with crude oil? Feels like it's been sliding.
It has. The outlook for crude has turned decidedly bearish. West Texas Intermediate WTI futures are hovering near two-month lows below $63 a barrel. The main reason? Forecasts of a massive and growing supply glut. The International Energy Agency, the IEA, put out a warning saying global oil markets look ever more bloated. They see supply far outpacing demand growth right into 2026. And the U.S. Energy Information Administration, the EIA, even projects Brent crude could fall below $60 by the fourth quarter of 2025. It suggests the market's much more worried about these fundamental supply-demand imbalances than about geopolitics right now, and that has potentially big deflationary implications.
Lower oil prices help with inflation. That's good news for the Fed, maybe.
Potentially, yes. Cheaper oil means lower gas prices for you, lower input costs for businesses. That helps cool headline inflation.
And what about gold, the traditional safe haven? How's it reacting to all these mixed signals?
Gold's kind of in a holding pattern, consolidating. Spot gold is trading around, say, $3,340 to $3,350 an ounce after a recent run-up. It's getting support from those high odds of a Fed rate cut. Lower rates reduce the opportunity cost of holding gold since it doesn't pay interest. A weaker U.S. dollar also helps. But it's hitting some technical resistance near $3,500. It probably needs a fresh catalyst to push significantly higher from here.
Any other commodities giving us interesting signals? Maybe something surprising.
Well, natural gas futures look bearish. They're testing a key long-term support level between $2.06 and $2.70. A break below that could mean more selling. But here's a really important contradiction, especially for your everyday budget. While energy prices are showing these deflationary trends, the USDA, the Department of Agriculture, is forecasting that prices for key food categories will rise faster than average in 2025. We're talking eggs, beef, sugar, non-alcoholic drinks, things you buy every week. So persistent inflationary pressure there. And that divergence, that's a huge challenge for the Fed. Falling energy helps headline inflation, giving them room to cut rates. But rising food prices keep squeezing household budgets and make underlying inflation feel sticky. It's a real balancing act for them. So if we try to tie all these threads together, the market today is just a fascinating study in contrast. You've got optimism fueled almost entirely by Fed rate cut expectations. But then you have this mounting evidence of a real economic slowdown, highlighted so starkly by that Deere report. We're seeing this clear split. Financial market hopes versus real economy struggles.
The resilient high-end consumer versus the strained mainstream one. Deflationary energy versus inflationary food. It's complex.
And this next point really drives home that complexity. The market's reaction, how it digests that July producer price index data coming out shortly, that's going to set the tone for the whole day, maybe longer. We basically have two clear scenarios, right? Scenario one, the PPI data is cool. Comes in at or below expectations. That validates the market's dovish view, probably sends stocks higher, bond yields lower. It solidifies the September cut narrative, boosts the soft landing story.
Right. That's the optimistic path.
Scenario two, the data is hot. PPI comes in higher than expected. What happens then?
Then you could see a significant risk-off move. Stocks selling off sharply, bond yields lightly rising. It would force the market to seriously reconsider the certainty and maybe even the size of those expected Fed rate cuts. What specifically could make the Fed hesitate?
Exactly. What would make them really pump the brakes despite market pressure?
It would be signs that inflation isn't just temporary, that it's becoming more embedded. A hot PPI, especially if, say, jobless claims, also surprise to the upside, suggesting the labor market isn't cooling enough. That combination signals persistent price pressures, even as growth might be slowing. That's stagflation territory. And that puts the Fed in an incredibly difficult spot. But regardless of how the PPI number lands, those themes from earnings today, they'll keep playing out. Investors are likely to get even more selective, favoring companies showing pricing power, maybe those exposed to that resilient luxury consumer, punishing companies tied to cyclical downturns like heavy machinery. And that tension we talked about, the huge AI growth story versus the geopolitical restrictions impacting companies like Applied Materials, that remains a key focus for tech. Eman's report after the bell is definitely a must-watch.
It really feels like the market is walking a tightrope right now, and today's data could determine whether it keeps its balance or takes a tumble. This deep dive has really shown us just how many powerful and sometimes conflicting forces are swirling around the market right now. Global signals, company specifics, it's a dynamic puzzle.
It absolutely is. And maybe this raises an important question for you listening right now. In this kind of market, driven so heavily by hopes for Fed action, but also showing these tangible signs of economic stress, how do you personally tell the difference? How do you discern between signals pointing to a maybe beneficial soft landing and those early warnings of a more serious downturn when you're thinking about your own financial decisions?
Definitely something to chew on. That's all for this deep dive. We hope you feel a little more well-informed and ready to navigate these fascinating and, frankly, quite complex market currents. Join us next time for another deep dive.